Wing. Okay, so this mock exercise focuses on intercompany consolidation with intercompany profits. We may with either inventory or land profits, and the company that we're going to look at is L, M, and Q company. So here's the question. So normally what I do is I look at the required also first. So that's a good habit to do that because you want to know exactly what analysis is expected of you. So this one, it's asking us to calculate the profit attributable to M shareholders for the current year. So they want us to calculate. So we're not asked to prepare a proper format, good form, consolidated income statement, but it's asking us to calculate the consolidated profit. And then for part B, it's asking us to calculate the consolidated retained earnings at the beginning of the year. Okay, so let's read the question. The question starts with L owns a controlling interest of M and Q. And L purchased 80% of M. So this is the parent. These are the sub. And M, they purchased 80%. At the time when M reported the retained earnings, again, we're going to need these beginning retained earnings. Why? Because we're only including in the parent's financial statement any earnings and any dividends subsequent to the acquisition date. That's the key. L purchased 70% of Q at the time when Q reported retained earnings of 50. Again, we're going to need this as well. So I'll just write down Q, and this is M. Okay. Now, we are given the beginning retained earnings of the year, profit, dividends declared, and then the end of the year retained earnings. Okay, so we've given a whole bunch of information that I'm sure we're going to probably need, come back to. It says Q sells parts to L, which after further processing and assembling are sold by L to M. So this is kind of how it works, right? It's essentially Q sells to L, then L sells to M. That's kind of the earnings process. Okay. Intercompany profits include raw materials at the beginning and inventory estimated below. So these are already the profits. So we don't need to multiply that gross profit percentage, unlike the other question. Okay? Now it says sale on sales from Q to L. This is how much. And from L to M. Now we're going to need to know that because obviously we have different ownerships. L uses the cost method, important to know, to account for its investment. And the tax is 40%. So we need to know that too because a lot of these transactions needs to be eliminated on an after-tax basis. Okay, so now we've got enough information, we can start solving the problem. So first of all, we need to analyze the profits, right? So the intercompany profits. And again, just like the previous question, I like to use the three-column approach. So you got before tax, 40% tax, after tax. So let's analyze. So if sales from Q to L is 90, so that means it's Q selling, okay? And sales from L to M, that would be L selling. So we need to itemize those. We need to highlight them. And again, I like to always separate the beginning and the ending inventory. So this first one is Q selling. And that was 90,000. And these are already the profits, right? These are the profits. And the tax rate is 40 times 9 is 36,000. And that's 54,000 net of tax. And L selling. And this one's 52,000. 20,800, the tax. And that's 31,200. Let's analyze the ending inventory. We're told that the ending inventory, again, Q selling. Again, these are profits. Okay, so now we're asked to calculate the consolidated profit. So I'll do that on the next page. So we always start with the parent. So what's the profit of the parent? 580. Now, do we have any sales that L did? And the answer is no, because we do have sales, right? So let's deal with that. So this is L selling beginning inventory and L selling ending inventory. So we need to eliminate those, and we need to recognize. So we need to add the beginning inventory profits. I'll put a plus beside it. We need to deduct the ending inventory profits held back. So this is now realized, held back. That is 70,000. I'm going to put a bracket, 800. Now I got that from these numbers, okay? So why don't I label these A, B, C, and D? Makes probably easier, isn't it? So we're going to take 70, 800, and we're going to recognize 31,000. So this is B and D. Now, what else did we know? We know that there were dividends that were declared. Because they used the cost method, remember it says the cost method? It means that they would have recognized the dividends that the subsidiaries of M and Q declared as dividend income. So we need to take away less dividends. The first one is from M, and it was 80. Remember, we own 80% of M, so 80% of the dividends declared of 200,000 we need to take away. And this is from Q. Overall profits, the adjusted profits for L is 275,400. Okay, so that was a bit tricky, wasn't it? You got to figure out that if they used the cost method, we would have had to, it would have been, you had to deduce from the fact that if they used the cost method and both M and Q declared dividends, we would have had to realize that they would have recorded it as dividend income. And of course, by doing so, we need to deduct it from the 580. Now, let's start with the first subsidiary. It's M, so M company. So let's do that one next. Profit. Profit of M is 360, right? 360 over here. Now, were there any intercompany transactions at all? So none of them were selling, right? So we don't have to adjust for it. Now, what's missing from this question are the acquisition differential. So they've excluded that completely because they just want to focus on the intercompany elimination of intercompany profits. So in this case, there were no adjustments. So we'll just put that on this side because I want to add it to that one. Okay, so now let's do Q. So let's start with profit. That is 240. Okay, and I got that from here. Now, we know that Q, there are a whole bunch of, again, we're going to realize this profit, and we're going to unrealize the ending inventory of 21,000. So let's do that one. So we're going to add beginning inventory profit realized, and we're going to label that as B, right? 54,000. That's 54,000. And we're going to label that as A, sorry, because it was labeled A, wasn't it? That's this number here. Okay, now we're going to deduct ending inventory profit that's now unrealized, and that is 21,000. Let's call that C. We get 273. So if I add all of these three, I get 908. This is the consolidated net income. Now, how much goes to non-controlling? So we know that NCI is, now we own 80%, so NCI is 20% times 360. Okay, so 20%, so 360 times 0.2 is 72,000. I could have figured that out myself. And NCI, how much do we own? We own 70%, so this would have been 30% times 273. So 273 times 0.3 gives me 81,900. So NCI equals 20% of 360 plus 30% of 273 gives me 153,900. Then L portion is the difference between 908, 400 less 153,900 equals 754, 500. Now let's do part B. It's asking us to calculate the beginning. Remember, it asks us to calculate the beginning consolidated retained earnings. So calculate the consolidated retained earnings beginning of the year. Now, why did they ask us to do that? Well, just in case we're ever asked to prepare and complete a set of statement of retained earnings, consolidated statement of retained earnings, then we need to have a beginning and add the beginning consolidated retained earnings, add the consolidated net income, less the dividends declared by the parent, which is L company, to give us the consolidated retained earnings at the end of the year. So that's why sometimes they'll ask us to do one of these statements. Okay, so we always start with the retained earnings of the parent, and that is 976. Now, remember, the beginning inventory would have been adjustments that we would made at the end of last year because we're doing the beginning retained earnings. In this case, L is selling, so we're going to have to take that into account because we're going to unrealize that 31,200, right? Label that as B. So this is the less beginning inventory profit unrealized. Why? Because we're doing the beginning of the year. So the adjusted amount is 944,800. Again, same thing. We're going to analyze the first sub, which is in this case M's retained earning. M's retained earning beginning of the year is 843. Now, what about the M's retained earnings at acquisition? Because remember, we only want to pick up our share from the date of acquisition. That was given to us. Now, there are no acquisition differential, there are no inventory or any unrealized profits, so we're just going to take 80% of that. What about Q? Q's beginning retained earnings is 8,682. Q's retained earnings at acquisition is 50. The difference is 632. Now, Q sold, right? There was a $54,000 profit. We're going to take that out. Less beginning inventory profit unrealized. Let's call that A to give us 578. At 70% ownership gives me 404,600. Add those three, you get 1,623,800. This is your consolidated retained earnings beginning of year. Okay, thank you.